Here's something that sounds impossible but is completely true. The stock market has made more people wealthy than almost any other invention in human history. And yet, if you put 100 random people into the market today, history tells us most of them will walk away with less money than they started with. Not because the market is rigged. Not because they picked the wrong stocks. But because of something happening inside their own heads that they don't even know is happening. Today we're going to break down why most people lose money in the stock market, and it has almost nothing to do with intelligence, and almost everything to do with psychology. Let's start with a simple scene. Imagine your friend Alex. Alex is smart. Alex has a good job, reads a few finance articles, and decides it's time to start investing. Alex puts in $2,000 into a stock everyone's talking about. For the first few weeks, the stock goes up. Alex feels brilliant. Like he's finally cracked the code everyone else missed. Then one morning, the market dips. The stock drops 10%. Alex's stomach turns. He checks the news. Some article says the economy might slow down. Another says inflation is rising. Alex starts sweating. A week later, it drops another 10%. Alex can't sleep properly. He keeps refreshing the app every 20 minutes. Finally, after 3 weeks of this stress, he sells. He just wants the pain to stop. 2 months later, the stock recovers completely and goes on to double. Alex missed it. Not because he was unlucky, because of what was going on in his mind in that moment. This story repeats itself millions of times, in millions of forms, across every country in the world. And once you see the pattern, you'll start noticing it everywhere. So let's talk about the actual belief that gets people into trouble in the first place. Most people think investing is about picking the right stock. They believe success in the market comes down to information. Find the right company, get in early, and you win. This is the story Hollywood tells. This is the story social media tells. Someone posts a screenshot of a stock that went up 500%, and everyone thinks, if I just find the next one of these, I'm set. But here's the problem. Investing isn't primarily a game of information. It's a game of behavior. You can have the exact same stock, at the exact same price, and one person makes great returns while another person loses money. Same investment. Different outcome. Why? Because the difference isn't what they bought. It's how they behaved after they bought it. There's actually research on this. Investment companies have studied something interesting for years. They compare how well a particular fund performs, versus how well the average investor in that exact same fund actually does. You'd expect these numbers to be almost identical, right? Same fund, same returns, should mean same results for everyone in it. But that's not what happens. Again and again, studies show that the average investor earns noticeably less than the investment itself earns. The investment goes up nicely over time. The people inside the investment, on average, make significantly less, sometimes earning only half of what they could have, simply based on their own decisions. How is that even possible? The fund is the fund. The returns are the returns. It's possible because of timing. People don't simply buy and hold. They buy when they feel excited and sell when they feel scared. And those two emotions tend to show up at exactly the wrong moments. This brings us to the real concept behind today's video. The biggest threat to your money isn't the market. It's your own brain. Let's break down why. Your brain wasn't built for investing. It was built for survival. Thousands of years ago, your ancestors needed quick instincts to avoid danger. If something looked threatening, the brain's job was to scream, "Danger," immediately and make you react, not think calmly for 10 minutes. This instinct kept humans alive in forests and on plains. But it's terrible for handling a stock chart. When your portfolio drops, your brain doesn't see normal market fluctuation. It sees a threat. The same part of your brain that would react to a loud noise or a sudden movement also reacts to red numbers on a screen. It triggers stress, anxiety, and an urge to do something, anything, to make the discomfort stop. And the easiest way to make that discomfort stop, in the moment, is to sell. This is called loss aversion, and it's one of the most well-documented patterns in human psychology. Losing money doesn't just feel bad. It feels roughly twice as painful as gaining the same amount feels good. So losing $100 hurts more than gaining $100 feels nice. This is why people panic sell during downturns. Not because it's smart. Because the pain of watching the number go down feels unbearable, even when nothing has actually gone wrong with the long-term plan. Now flip the situation. The market is going up. Everyone around you is talking about some stock or some trend that's making people rich. You start to feel something different. Not fear this time. Something almost the opposite. This is why people often buy at the worst possible time, right when prices are already high and excitement is at its peak, and sell at the worst possible time, right when prices are low and fear is at its peak. Buy high out of excitement. Sell low out of fear. Repeat. If you wanted to design the most efficient way to lose money on purpose, you'd struggle to come up with something more effective than this exact cycle. Yet it happens to smart, capable people every single day, because it's not a logic problem. It's a wiring problem. Let's use a simple comparison to make this click. Imagine you plant a tree. You water it consistently. Some weeks it rains too much. Some weeks there's a drought. Some days a storm bends the branches and it looks like the tree might not survive. If every time there was a storm, you dug the tree back up to check if the roots were okay, you would kill it. Not because storms are dangerous to trees. Trees are built to survive storms. But because constantly digging it up disturbs the one thing it actually needs to grow, which is time, left undisturbed. The stock market works the same way. It is, by nature, stormy. Drops, dips, and scary headlines are not signs that something has gone wrong. They are simply the weather. The tree, your investment, is designed to handle that weather over time. The danger isn't the storm. The danger is you, pulling it out of the ground every time you get nervous. So now let's get into the real insight, the thing that separates people who build wealth from people who don't. It's not intelligence. It's not luck. It's not even knowledge, as strange as that sounds. It's the ability to do nothing. That's it. The number one skill in successful investing is tolerating discomfort without taking action. While your instincts are screaming at you to do something, the people who actually build wealth have trained themselves to sit still. Think about how strange that is. In almost every other area of life, doing nothing is seen as lazy or unproductive. But in investing, doing nothing, consistently, calmly, for years, is often the entire strategy. This is also why so many people quietly outperform experts, without realizing it. There's a well-known pattern where people who simply forget they have an investment account, or rarely check it, tend to perform better over long periods than people who watch it daily. Not because ignorance creates wealth, but because checking constantly creates the emotional triggers that lead to bad decisions. Watching a chart all day doesn't give you more control. It gives your fear more opportunities to act. There's also something deeper going on with how people think about money itself. Many people treat money as something tied directly to their self-worth. When an investment drops, it doesn't just feel like a number went down. It feels like a personal failure, like a verdict on their intelligence or their judgment. That emotional weight is exactly what makes people act irrationally. They're not just protecting money. They feel like they're protecting their ego. Once you separate your identity from your portfolio, the storms stop feeling personal. They just become weather again. So what should you actually do differently? First, expect the dips. Don't treat them as emergencies. A drop in your investment is not new information about your future. It's simply part of how markets have always behaved, in every decade, in every country, throughout history. Second, build a plan before emotions show up, not during them. Decide your strategy when you're calm, not when you're scared or excited. The worst financial decisions are almost always made in emotional peaks, not calm moments. Third, reduce how often you check your investments. This isn't about being careless. It's about protecting yourself from your own instincts. The less frequently you check, the less frequently your brain gets a chance to panic. Fourth, focus on time in the market, not timing the market. Trying to predict the perfect moment to buy or sell is extremely difficult, even for professionals who do it full-time. But staying invested consistently, through the ups and downs, has historically rewarded patience far more reliably than trying to outsmart short-term movements. And finally, remind yourself often that a temporary drop is not the same as a permanent loss. You only lose money if you sell during the dip. Until then, it's just a number moving, not money disappearing. So here's the real truth behind why most people lose money in the market. It's not because the market is unfair. It's not because they lacked some secret piece of information that wealthy investors have access to. It's because the market quietly tests something every single person carries inside them: patience, emotional control, and the ability to sit still while uncertainty plays out. Most people fail that test, not because they're foolish, but because they're human. Their brain is doing exactly what evolution designed it to do, just in an environment it was never built for. The people who succeed aren't the ones who never feel fear or excitement. They're the ones who learn to recognize those feelings, and choose not to act on them. So the next time the market drops and your stomach turns, remember the tree in the storm. The roots are fine. The storm will pass. The only real danger is reaching for the shovel.